For our interview this month, I'm joined by Owen Kyffin, one of the partners at Whitley Stimpson, who is going to talk about an area that I've been asked an awful lot about as I tour the country. People are very familiar with property tax. We're quite happy. We generally still call it Schedule A. But we're happy with the income side. We're happy with the capital side. When something has happened, it tends to be an area of taxation where we're very reactive to a situation rather than proactive. And Owen is going to tell us a little bit, I hope, about dealing with property companies and the fact that an awful lot of people come to a firm and say, okay, I'm going to own lots of houses, I'm going to own half of the town, but how should I do it? Should I do it as a company or should I not? And I'm guessing there isn't an answer.
There isn't. I think it's very much one of these things where you have to look at the particular circumstances that you're dealing with. And there's really no substitute for running through the numbers just to make sure you've arrived at the best possible outcome, or at least what you can only judge at that time is the best possible outcome.
And take us through your numbers then. Obviously, income tax versus corporation tax would be one.
Absolutely, yeah.
But what about the others?
Well, you've also got to consider whether there are any capital gains tax implications, because often someone will come to you where they've already got quite a large property portfolio in their sole name or maybe in joint names with their spouse. Now, they might see the attraction of a 20% corporation tax on the profits from those properties once they're in the company, but of course the first step you've got to look at is to see whether there are any pregnant gains in those properties that are going to crystallise on a transfer into the company, and for which you're very, very unlikely to get any holdover or rollover reliefs.
So moving the assets into a company, if you've already set up your portfolio, can be a very risky business.
Absolutely. I mean, you've got, as we've said, the capital gains tax, but also you've got potentially a whack of stamp duty getting the properties in as well.
Okay, and of course these days we also have to look at the whole enveloped property rules and the ATED and all that sort of thing, and that bites a lot lower than it used to bite, doesn't it?
Yes.
It's a much bigger issue than it once was. But moving away from that, I know inheritance tax is a big talking point whenever we come onto property ownership, and there is this idea that somehow if we distance ourselves from the property, we've distanced ourselves from the inheritance tax. But with a company, you would still have the inheritance tax issues to deal with.
You would indeed, because the value of your shares then would fall into your estate for inheritance tax purposes rather than just the straight value of the property. But there are some potential advantages with it. In terms of if you can afford to take a very long-term view, you might be able to get a reasonably robust valuation of the shares in the company that you're happy will stand up to muster, and you can then maybe distribute them down as a couple to children over a number of years. Again, it might take a very long-term approach to shift any significant value out of your estate, but it does allow you to kind of split up the chunks in which you're doing it.
Okay, so and obviously there's also the income tax, corporation tax we talked about, capital gains tax, inheritance tax, these various stamp duties and ATEDs and what have you. But something I want to talk to you about, rather than the ins and outs of the tax rules, is really in terms of when you're at your desk and people come and say to you, I want to do this, I want 20%. How do you persuade them that actually this might be the better option or that might be the better option?
Really, it's a question of working through all of the pros and cons. Having said that, once you've got the property into the company, you've then got to get it out again. So, albeit, if that property increases significantly in value, the company is likely to only pay 20% on any capital gain it makes on selling the property. You've then got potentially another charge to tax on getting that money out of the company. I think generally what I say is if people are going to take a very long-term view, it's maybe worth looking at the company route, because they may then be able to roll cash up in the company or roll cash into new investments in the company, only paying tax at 20%, whilst they're a higher rates tax earner. And if, as many people do, they're viewing this company as part of their pension planning arrangements in the broadest sense, they can then start taking income out of the company once they're no longer a higher rates taxpayer. So it goes back to the old cliche that we're both familiar with, that a tax deferred is a tax saved.
And obviously a lot of people will already have a company, and presumably you see an awful lot of situations where people put some rental properties into an existing trading company, but that can be a complete disaster.
Oh, absolutely, yes. I mean, one, you're veering away from what the main purpose of the company is, and really, if you are running a business, that should be your sole focus in that entity, generally speaking, is my simplistic way of looking at it. Secondly, you're tainting the status of that company potentially for capital gains tax entrepreneurs relief, for inheritance tax business property relief. So really, it's something that needs to be considered very carefully. Having said that, what you can, under certain circumstances, do is you can get a certain amount of value that wouldn't qualify for, let's say, business property relief, to qualify, provided it stays under the limits as specified in the legislation. But as I say, you know, who's got a crystal ball? And it's one you do have to be extremely careful with.
And of course, we were talking in the news earlier in the programme about the fact that these rules seem to be so fluid in terms of whether you cross a line or don't cross a line. We were talking earlier about the introduction of looks like introduction of Class 2 national insurance on property income. And so we're looking at a whole range of issues within property. And as you say, the fact that currently you can have 50% of your assets as investments and still just be inside the inheritance tax rules, but for capital gains tax it's only 20%, we're looking at a very complicated area. So it's not, as you were saying, it's not a simple matter of saying, well, look, this is always the answer.
Exactly, especially when the Inland Revenue say 20%, but won't tell us it's which 20% they particularly are going to pick on that occasion.
Of course. So when talking to your client, it's a case of going through the numbers with them. And then how do you deal with the ongoing, you know, work for a property business? Is it a case of saying, actually, we chuck it in because you're already a client for something else? Or are you finding more and more now that you have sort of mini property tycoons?
We do certainly have many property tycoons, and it's something that takes over sometimes more and more of their activity. And there's always the danger there, which you have to point out to people, of when that property investment activity strays over into property development, which HM Revenue and Customs are clearly going to be eager to try and tax at income tax rates.
As a trading activity.
Absolutely.
Rather than as an investment, sure. But in terms of your you know, a lot of firms I know will say, well, we do a tax return because you have your own business as a trader, what have you, and so we charge you this amount for that. Oh, you've got a few houses, fine, we'll chuck that in as part of it, in the same way as you might throw in the bank interest or a few dividends. But actually, how do you go through the process of saying, actually, we need to look at how we're charging you because of the number of properties you've got?
Well, obviously, if we're charging them specifically for drawing up the letting accounts for the property, that's likely to be tax deductible against the property rent. So that's a way both of selling fees to them and indeed a way of helping them minimise their taxes.
But wouldn't be deductible against their trading business, of course. So you need to have that separate listing on the bill to show that detail.
Or indeed, they might not have a trading business. You know, if they're just holding investments, if we can get any part of our fee tax deductible, that has to be a bonus.
Yeah, that's a very good tip. The idea of making sure that with the itemised billing, effectively, we can explain that we're deducting against different things. If you could give one tip to our viewers about dealing with people, so a new client turns up, they want you to look at their property portfolio and how am I taxing this and everything else. Where do you start? What's the first thing you would do?
The first thing I think I would do is probably sit down and get absolutely nailed down the history and the transactions with all the properties involved, because you can go off making assumptions about capital gains tax, which might be involved in transferring a property into a company, but then find that one particular property they've lived in for a significant amount of time. And once you know that, all bets are off, and it's back to the drawing board in determining what the tax due is.
Yeah, okay. So as usual, the answer is full information is the way forwards in terms of making sure your clients are well looked after.
Absolutely.
Owen Kyffin, thank you very much indeed. Now it's time for Admin Minute.